hope everyone's doing well and welcome back to another lesson. So cool. Now, with this lesson, it's not necessarily a lesson I planned on making, but after having quite a few conversations with you guys, being on quite a few Zooms, I do think it is one that is going to help a lot of you. With some of you guys, it may even open your eyes to things that you didn't realize you were potentially missing or not considering, right? Now, with this lesson, I will try not to stretch it out when I'm talking, right? Because the idea here is to simplify what we are doing. What you guys will see is I'm going to make a lot of broad points, and everything will have a reference back to the earlier lessons in the mentorship. So if you see something today, you see specific points, they're not making sense to you, there's practically a lesson for every single thing that is going to be mentioned that you can go back to and consider. Okay? If you're not confident in something, you need to revisit those lessons. Now, the idea of this lesson, when I talk about structuring your trading, is to help you guys build a shell of what you can do, a sort of guideline of what to follow. Now, it may not include everything that I mentioned today, and other times it may include all of it, right? It will depend. It's very context dependent, and you guys will see that. So let's get into it. Now, cool. The way I'll break things down, we're gonna, start with that top-down analysis approach, the higher time frame and the macro analysis coming first. Now, why is this very key here, right? Now, a good thing is, it's December, we're getting into January, price action has slowed down and it's not offering as many opportunities as usual. Price action is becoming a bit lackluster now, right? That's fine. Now, what this means is a lot of people probably will switch off. That's okay. Everyone does deserve a break. And even if you start doing other types of work, backtesting or whatnot, you're not going to be in sync with price action. You guys will see why this is important. Because typically, when we trade day to day, week to week, or even month to month, you're practically in sync with price action. You've, got a drawn liquidity, you're working towards this. If this drawn liquidity gets hit, then you have the next expectation and so forth. It's always moving. Price action's moving, and therefore your expectations are constantly moving as well, right? Now, the reason why I say this is good is because we're about to go into January. And January, if everybody's coming back after a break, we have a sort of hard reset. So everything I'm about to put in this lesson, you guys literally get to have a go at, right? You get to come back, you start with your high time frame analysis, see where you stand with the charts, what you expect from them, what you want to see, and then, of course, apply that. So cool. Now, taking it literally all the way back to lessons 1, 2, 3, 4, wherever we mentioned the fundamental analysis, right? Understanding the interest rates, the supporting data, the other news events that follow, the GDP, the CPI, the NFP, everything. And using those to form a bias, right? Now we've had an FOMC just pass and it's set a sort of precedent, right? There's been another pause in the markets. The interest rate has not moved up. So what has the dollar done? The dollar has moved down, right? We know this. We know when interest rates go down, the dollar will also go down, right? Just basics. I'm not going to get into the details, like I said. If something like that statement I just made, if that doesn't make sense to you, and when I say sense to you, it shouldn't just be like, oh, interest rates down, interest rate up, dollar up. No, you need to actually understand it fundamentally. You need to understand why that is happening. That is a mechanism of, the macroeconomic environment. So it's very important you understand that because it does impact the charts, right? So cool. Of course, don't want to stray away from the point. Now, having taken these things into your analysis first, then we can hop on the charts and think about, okay, cool. It's very basic, right? The first thing we look for is the direction of the market. We want to know, on the dollar, are we going to be bearish here? Are we going to be bullish here? Up or down? Simple. Now that you have a simple bias of up or down based on your fundamental analysis, we can then come onto the technical analysis, right? Why? Because of course we're going to be bullish or bearish, but what are we going to be bullish or bearish towards now? This is where we can start to establish targets in the market. We can start to establish, right, our potential higher time frame fair value gaps, liquidity targets, liquidity pools on the higher time frame and whatnot, and recognize this as a higher time frame drawn liquidity that we are indefinitely working towards. Right now, alongside this, technical analysis, what we can add are these other things. With the cut data, it's a bit of both. It is fundamental and technical in my eyes, but it's definitely something we can use that everybody should be using, especially when we have these sort of breaks and we're coming back. We want to have a good idea of where smart money is moving, what are they doing in the market, and does that follow suit with our fundamental analysis, right? Another thing to be aware of that, it is a very nice and neat concept. I do think a lot of people forget about it, is the data ranges, right? If sometimes you're confused or a bit unsure, but there's a clear daily market structure shift and you use the data ranges, what does that do? Gives you a target for the 20 days, the 40 days, the 60 days, and so forth. It gives you something to work with, right? With bias, I do understand, in an ideal world, it's top down. We're going to start on the higher time frame. We're going to do this, do that. But there will be times in the market where you do not have a bias or you may be confused, especially as a beginner. It's not always easy to take a stance. So sometimes it is fine to work backwards. Oh, I've just seen a daily market structure shift. I didn't have a bias. But now let's think about it. Cool. I've seen a daily market structure shift towards the upside, right? It's a bullish market structure shift. Um, does the fundamental analysis support this? And whatnot. And you go through these same things, you go through that same checklist. If it now makes sense, maybe it's something you can consider. But like I said, all of these things are content dependent. And ideally, you're well versed in all of these things, understand how they work, and use them to start your analysis, and then hop on the charts and start doing the technical stuff, right? So with the high time frame macro analysis, there is a lot there. There's a lot of things to consider, a lot of things to learn and be confident in to use it properly, right? And here I've just condensed into 3 lines. So again, like I said at the start, if there is something, you have gaps in your knowledge, or even with some of you guys, if you just want to do further or extended reading just to get a better idea of how some of these economic things work, because I never studied economics at school. Everything I've picked up is from when I started learning trading and just doing my own reading and, getting into, and even now I'm still constantly learning new things that feed into the trading to give you a better understanding and idea of how the markets are working and shifting constantly, right? It's something you can choose to do. Cool. Now, past the high time frame macro analysis, what can we do, right? Now, this is the approach that I've taught you guys, and I want you to definitely carry on using, right? We put a big emphasis on opening prices. And why have I mentioned candle-based trading? Because of course, we're doing, trading based on the candles, but in this specific scenario, I mean singular candles. I say this to you guys quite often. If we can condense the bias into a singular candle and our expectation of this candle, our life becomes easier, right? So now some of the things to consider are the high time frame candles first of all, right? The opening prices of them. So when I say high time frame, that could even mean the yearly candle. It could mean the 6 months, the 3 months, so forth, and then on to the monthly, the weekly, and the daily from there, right? And for all of these, we want to, be using Forex Factory, understanding where the news events lie, especially within these three, the monthly, weekly, and daily, because that's when we get very sort of unique news events. And what I mean by that is, you're only going to have one NFP in a month, one CPI in a month, and so forth, right? So every time we have a new monthly candle, we want to consult that Forex Factory. Same with the weekly, same with the daily, right? Why? Because we're pairing the time with expansion. We know that price is likely to move when we have these big news drivers. Why? Because there's an injection of liquidity that applies on a day-to-day basis, also on a weekly and a monthly basis. If the first week of the month has almost no news, and then the second week of the month has about 4 red folders, which week is likely to set up the expansion of the month, right? Most likely the second week, right? The first week, if it's not got a lot of new drivers, is much more unlikely to move. Now, that same logic applies to the weekly and then the daily, right? So the days within the week and then the sessions within the day. If that makes sense. Just try and visualize that. It's a very fractal concept, right? Sessions within the day. So what do I mean exactly by that? Forex Factory, we look at it for just the day, right? what news events are they today? When are the news events? So what does that mean? When is the likely expansion going to occur, wherever it is, and you can plan your trading around that, right? Then we can look at the week, right? Rather, we're going to come from the top down, but just for the sake of me explaining it, we can be looking at the week and understand, okay, cool. In this week, there's a red folder on Tuesday, Wednesday, and Friday. So what does that mean? Most likely, if there's no news drivers on the Monday, sit out later pass. We usually say that for Monday anyways, but if there's no red folder at all, it's even more reason to let it pass. Wait for that weekly expansion to show the likelihood of starting. Now, when we start pairing these things, right, with the opening prices, right, for example, if we mark the Sunday opening price of the week and we see like, cool, Monday moves down, Tuesday has a news driver, and Tuesday does what? Just rips through that opening price. What has very likely happened? The expansion has most likely started, right? So now if the expansion has started, we can then create opposing targets, right? Or, well, it's not on the slide, but what I said is essentially making targets on the opposing side, right? Whether that's higher time frame value gaps, liquidity pools, whatever it is, and then trading towards them, right? Essentially just figuring out our draws on liquidity. In one of the last lessons I mentioned to you guys, we can have a short term, medium term, and a long term draw on liquidity. Right? And that's definitely important to understand because we're going to be trading all of these time frames simultaneously, right? But of course, just because you have a monthly drawn liquidity doesn't mean that every single day you will be trading towards that, right? So it's very key you understand that. So that is why we use the opening price here. It just becomes clearer for us. If we mark out the monthly opening price, right, the weekly and the daily, right, or rather New York midnight price for the daily, and we do on a regular basis, it becomes very easy to see how the candles form using these prices, these sort of imaginary lines that we're drawing on. And the same, it's not on the slab, but can be said for your session times as well, right? So cool. With this, let's open the charts and get a sort of visualization for it. Now, cool. A bunch of stuff on the chart. So now, as you guys can see, I already got one line marked out. What is this line? December's opening price, the monthly opening price. Price opens, move up, very slightly sweeping this buy side liquidity pool, run up, and then displaces through, right? So in this scenario, what occurs? Now, of course, I know we say December isn't necessarily a trading month, but this looks like something along the lines of a mid-month, early month reversal, right? That sort of profile. Why am I saying mid-month? Because, the 13th is where I would say we get the genuine confirmation that price is going to be bearish from here. Why? We one displays through the monthly opening price, but we two also push through these sell side targets and we do not revert after taking them. We don't take them, then reverse, we just rip through them and we stay down, right? That shows the likelihood of price being bearish. And as you guys can see, that bearish price action actually continues, continued for a few more days. And now this is essentially the consolidation for December beginning, right? So what has the opening price in this scenario done for you? It just made it super clear which way price is going to go. Now, as you guys know, right, we came into December bullish. We said, cool, it'll run this sell side target. Then we want to see it run this, buy side target. And then we want to see it run this buy side target. And then what happens? Price goes and runs one of the buy side targets, then displaces lower. So what does that mean? We were essentially offside. That's fine. That's nothing to worry about. It's just about being able to adapt. This is one of the many signals that price is giving you that your directional bias here is wrong now. You need to turn to the other side. So cool. Now that we turn to the other side, right? If on that specific Wednesday the 13th we've now become bearish, what can we establish? We can establish our first sell side target, which is this. Absolutely gets wiped through, right? If you guys also remember, another target I gave you guys has been hit now is the monthly rejection block. And another one I've marked is the 50% of this rejection block. Right? So that's what we do. We adapt to the price action when it has given a confirmation. And once we have that now directional bias confirmed, we can then start looking at, these are the targets for price. This is where we can see price go here, go there. Now that same logic will be applied to our yearly candle. So what's one important thing that I'll be marking when the year opens? The yearly opening price, right? Whatever price it opens at. And then we'll be seeing which way does price offer a move first. Now let's just imagine, right, where price is, price closes here. Closes right where it is, yeah? And then January's candle opens. If January's candle starts by making a move up here, sweeping December's high, moving into this balanced price range, and then shows a level of rejection, or perhaps February will show a level of rejection, right? Doesn't necessarily have to be January. What is that showing? Right? If we start forming a 3-bar swing in this, February moves away, displacement lower, that could potentially be the high the year put in, right? It's something to consider. Now, the opposite way, what could happen is price closes here, or rather opens here for the new year, and then what happens? We pay down. What's this low? This low is the previous yearly low, right? The previous candle's low. So what if we come and sweep this sell side, and then we displace higher towards what? Higher towards the yearly opening price. When we displace through that yearly opening price, it's showing a likelihood of what? Expansion beginning. Now, what was key to this expansion, guys? What was very important before this expansion began? Where price manipulated. Both of these targets are logical, right? What I'm explaining here right now can be applied to the charts as we go into January. Which way is price going to move first? Is it going to displace away from there? Because you know what it is? Price could move to this fair value gap and not displace away. And you could get caught offside. That is what we're looking for. We're looking for a move, or rather the manipulation to an array or a target, and then the displacement through the opening price for it to confirm our bias, right? And now that's on a yearly level. Just because we're waiting for that, for the confirmation of our sort of yearly candle bias, doesn't mean we can't trade price action day to day, because we will be able to scalp up this way or scalp down this way, depending on what price is showing us on a day to day or a week to week basis, right? Cool. Hope that makes sense. Back to the slides. Cool. So now that you have an idea of what you expect on the higher time frame, right? We need to exhibit a bit of patience. We need to let that play out and, work with that bias. But now on a day-to-day basis, what should eventually happen is, right, now when you've worked your way down with the high time frame bias, doing the monthly, going into the weekly, going into daily, now you have your daily bias, right? The bias for the day is imperative for you to be able to trade your session. It's not just as simple as bullish or bearish. If you're bullish or bearish, we need to establish targets. Now, as a New York trader, I always say I do think it's a bit advantageous to be a New York trader, because some of the day has played out. The likely expansion has started. It makes it much easier for you to say, okay, cool, price is going to push towards this, push towards that. I could target this, I could target that, wherever it is, right? Depends on the context. But because some of the candle has played out, the easier it is to reach your bias. And that applies on all time frames, guys. The more of the week that has played out, the easier it will be for you to identify your drawn liquidity, right? If the week starts on a Monday, you could tell me, oh, price is gonna go, sweet previous weekly low, then no pump. But that's an expectation, right? Whereas now, if you start your week on the Wednesday and you come look at this weekly candle, you could say, oh, price is definitely heading for this previous weekly low. Why? Because on the Monday we made a high here, blah, 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 blah. You'll have your logical reasoning. Things that have played out that make it much clearer for you. That is the same thing that we want with our sessions, right? First, we start with the daily candle, then we come to session, bullish or bearish. Once we have that, we need to consider a place where price can manipulate. We want a clear manipulation to either an array or a target. And why have I mentioned target, right? It's just for, a liquidity target, essentially. It could be a fair value gap, it could be a high time frame order block, but it could also be sell side or buy side liquidity that price sweeps. It might sweep London lunches liquidity if you're trading, New York. It might be sweeping the Asia ranges liquidity if you're trading London, right? Once that manipulation has occurred in line with your expectations, then you can anticipate the distribution. Cool. Price first just swept the previous 4-hour candles low, right? It took London lunches liquidity, and now we have a bit of displacement, I think the distribution is beginning. Where is that distribution going towards? Oh, there's a 1 hour fair value gap we can target. Oh, there's a clear 5 minute market maker model, right? It depends on the context. There could be several things. There's a reason I'm not listing everything out, but this is why I say it's very important to have a comprehensive understanding of these things, right? A conversation I had with someone on Zoom recently was like, cool. Listen, if you go through all the lessons and you label them, 1 to 5, 1 to 10, and you essentially rate how confident you are with the lessons. I've said this before to you guys as well. The idea that most people will have is cool. Let's say we're rating the 1 to 5, 5 being confident, 1 being not confident at all. Most people think that, oh, I've got a few lessons on 5. Wow, these are my strong points. No, it's not about strong points. Trading is one of those things where everything needs to be on a 5 for you to be a good trader, essentially, right? Or at least that is the goal to work towards. You need a good understanding of everything because all the concepts can be used in a higher time frame. And then that same ability to have a very strong and good understanding will allow you to simplify things for the lower time frame when it comes to your sessions and anticipating these things, right? Now, it's all good having these expectations on price, but how do we execute on them? The session opens, manipulates, and then starts offering a move away. That is the ideal scenario that we're looking at. So when the session opens and manipulates, should we avoid that manipulation? Yes, right? The word manipulation itself has bad connotations. We do not want to be part of manipulation. When it's a higher time frame, it's a different argument, but we're talking about the session specifically here. The manipulation of the session will tend to be a much smaller move than the distribution of the session, right? Just, for the sake of example, the manipulation could be 10 pips, and then the distribution of New York could be 35 pips. Which move would you rather trade? The 10 pips or the 35 pips? Of course, the 35 pips, right? It's likely to displace more in your direction, give you a larger move to be a part of and catch, right? Now, open, manipulation, and then distribution. You have to ask yourself, has the distribution begun? What signals do you need from price? What signs does price need to show you that the distribution has begun? It could be a market structure shift. It could be displacement through an old fair value gap, creating a balanced price range. It could be, price moving up, creating a second leg. It's now respecting bullish arrays instead of bearish arrays. That is your confirmation. Cool. Now that you've had that reversal, what did I just speak about in the last slide? When the distribution has begun, what do you need to do? You need to establish a target on the opposing side, right? Price opens, manipulates to a 1 hour fair value gap, and now what can we potentially target? Oh, we can target previous daily high. It's within reach. It's within 35 pips, like we said earlier. So it makes a lot of sense that price will move towards this. So now when price gives you that confirmation, right? When it creates that first leg, what might happen, right? Price may displace through the opening price. That's one sign from price that the expansion is now beginning. And now maybe 7, 8 pips have been gone of the expansion, right? So what happens now? You still have a good 20 pips or even more than 20 from here to the previous daily high that you can get involved in. Bear in mind, price does not move in a straight line. It may move up, then offer your IO Fed or OTE, then move higher and higher. Until that drawn liquidity is hit, you may be offered numerous opportunities from price. And it is up to you to cherry pick which ones you will trade. In some scenarios, what will happen is you might get that initial market structure shift, but guess what? The initial market structure shift does not push through the session opening price. So you say, you know what? I'm not confident enough that I'm not going to trade this. Then what happens? The second leg comes of the market structure shift. It displaces through the opening price, and now you're like, okay, cool. Now I am looking for the next entry at discount that is offered, or the next IO Fed that is offered, right? Or the next total soup that's offered. And once I'm in that trade and my stop loss is in a safe position, I'm going to hold that trade towards my drawn liquidity or towards the local high, wherever it is. Contest-based scenario also depend on how you are as a trader, right? So just remember this: it's never one opportunity to align yourself. What you essentially need to recognize is price opens at point A, makes a move to point B, and then goes to point C, which is a drawn liquidity. That move between B and C is where we want to get involved. That is going to be the larger move of the session. And it should, ideally offer you a couple opportunities at least to get a nine. And sometimes it won't, and that's fine. If the opportunity isn't offered, that's fine, right? It happens. It's just a part of trading. But we are looking for those opportunities towards the drawn liquidity and then aiming for that drawn liquidity to get hit out. Another thing that's very important is time and price, guys. And this will be, again, very context dependent. Unfortunately, there's no one shoe fits all with all the trades we're going to take. But it's very important you realize, if I'm in a position and price has now, cool, I'm in a position, I'm in a buy, I'm targeting the previous weekly high, which is up here, but price is already swept the previous daily high. And now London close kill zone is approaching. What could happen? Price has swept buy side, it could very likely reverse. I'm about 5 pips away from take profit. I'm already in a good amount of profit. Is it worth closing my trade here? Yes. If you're not going to close your trade, at least hit your risk off the table. Ideally, just close your trade there if you're close enough to take profit anyways. But we want to consider time as well as price. What that means is understanding when your sessions are starting, sessions are closing, even 3 p.m., right? Or rather the start of London close kill zone. Sometimes we get news events, right? We get red folders. So, if you're in a trade before that, is it worth holding the trade through that news? Sometimes it might be super obvious. For example, we're in the middle of a market make model, it's very likely news is going to push price your way. Your stop loss is in a safe position. Fair enough. That's a good decision. But you need to ask yourself that every single time, guys. Again, remember I said this whole lesson is the guidelines for your trading. It's a sort of shell that's been given to you. It's things that you can, essentially use as a checklist and go through every time you take a trade. Does it make sense for me to be holding this trade through that or for this long? And then price itself, right? What signals is price giving you? If price suddenly now creates a 5 minute market structure shift against your bias, is it worth holding the trade? Is it just a sweep? Is it just a retracement? You have to ask yourself these things. You have to be very objective. Don't marry your trade ideas. If you're in profit, take your profit. If you're a bit shaky now or you're unsure, ask yourself, is it worth closing my trade? Is it worth trimming my stop loss? There's several things you can action based on how confident you are. And of course, again, just to reiterate, it will be context dependent. But that is why I'm putting an emphasis on asking yourself. Right? You shouldn't have to ask anyone else or need somebody else's bias to help you trade. You should be able to ask yourself and come to a sound and reasonable decision. It's very important it is a reasonable decision. Why? Because you need actual logic behind it. Don't make these decisions purely based off how you feel. Right? Watch the time and watch the price. Simple. Cool. One thing that we don't speak about, the following lesson is now going to be completely about journaling, and we'll touch on quite a few things. It's essentially journaling your day out. Lots of people do this differently. Some people will finish their trading day and instantly open their journal, add their trades, add their, data and whatever it is, however they do it. Some people do it at the end of the day before they go to bed. Now, I've heard a lot of different things. Me, myself, typically when I enter a trade, I pretty much take a picture of my trade idea. I start writing a few notes. Like this is just like essentially drafting my journal. And then once my session is done, I will add in the actual trade and show the whatever I do. The way I do it is very different to how some other people do it. So I don't want you guys to journaling is one thing, but I don't want you to necessarily just follow what I do. I want you to find out what's beneficial for you. And that's what the last point is about. We don't want to journal for the sake of it. There needs to be purpose and intent behind what we're doing. The whole idea of journaling is having a sense of self-awareness, right? To understand this is where I'm going wrong, this is what I'm doing good. So I will keep doing these things that doing good. And the places where I'm going wrong, I'm going to start making a change. I'm going to improve on this. How am I going to improve? Blah, blah, blah. That in itself is a whole nother lesson I will touch on, but I have already touched on journaling to an extent before. So it's very important you guys, you take these things in and understand. Don't just journal for the sake of it. Don't just write shit down in a little notebook or on your Notion and never look at it again. You need to actually use this input to get a better output, right? That is what the data is for. Guys, this is, when we trade, we essentially become a one-man business. Nowadays, right? How do you guys think businesses improve? A big part of a business improving or looking at their own structure, looking at data. Why? Numbers don't lie, right? You might think, oh, I'm a brilliant trader on Mondays. Why? Because in your head, all you remember is the previous Monday where you won and this Monday where you won. But then you go look at your journal for the year and you realize, oh, Monday I only have a 30% win rate. So what should you most likely do? Not trade Monday. Do you get it? The numbers don't lie. It's in front of you. That's what we want with our journaling. We want to use that input that we're getting, and then we get better output. And what's the output of that? We'll potentially remove Mondays from our trading, and then what happens? We get a higher win rate overall. So in the month, the year, whatever it is, we make more money, right? Cool. So the last thing I'll touch on is things to consider, right? Some people when we trade, when we have these trade ideas, I've tried to make it as sort of mechanical and robotic as I can for you guys. Now, sometimes what happens is you take a trade, you get a very clear trade, and you do well. And then what might happen is the next day, the same thing happens, but this time the trade might not go well, right? At the end of the day, nobody knows for certain where the market is going. If you are on a account, if you are live, if you have made a good amount of profit, there is no harm ever in sitting out. In ever saying like, cool, look, I've made 3%. I've had a super good start to the week. I'm gonna wait until Thursday or Friday to trade. I'm just gonna skip out Wednesday and Thursday, right? There's a lot of other things to consider. There's a reason I've written context-based situations because we got to consider news events within the week. When is the week actually going to move? You can't say I'm going to wait for the Friday, but the only red folders are on a Tuesday and a Wednesday. You get it? Doesn't really make a lot of sense. But the scenario that I'm getting at is right. Early in this video, I've told you guys, look, the longer the candle goes on, the clearer it becomes. The same applies to the weekly candle. If you know there's clear drawn liquidity, you can hunt the reversal after drawn liquidity has been hit and so forth. So what you might say is like, cool, I've started the week really well. I've made a good amount of percentage. I'm gonna wait to see the next super clear setup before getting involved, essentially, right? Wait for the high probability setups. Now, there's also no harm in trading 2 days back to back and, you know, doing well on trades. That's fine. But what I'm getting at here is, guys, with trading, sometimes you have to consider real life as well. There are, some people who might disagree with me here and say, it should just be like focus on the execution, focus on the performance, don't focus on the money at all. But we trade to make money. If you're on a funded account, you've made a substantial amount of money and you know you can get payout. I don't know, let's say you're on a 100K account, you made 3-4%. 3-4% is a lot of money. That's more than a lot of people's monthly wage. Perhaps it is a wise decision for you to, request that payout and just wait on the payout. In that time, what should you do? Of course, you're going to need to carry on trading. Buy a new account, right? Start training a new phase. There's always time to stack more capital, right? You don't necessarily have to pass one account and try to rinse that account. Trust me, guys, if you pass an account and you try to milk it, it is very likely not going to go well for you. And if it does go well for you, it might happen once, maybe twice if you're lucky, but not much more past that, right? So it's a wise decision to take that slow approach to trading, take the money when it's coming to you, and consider all these things together. Now that is it for this lesson. Ideally, what I hope has happened here is for some of you, it's just added a lot more structure and understanding of how to process your trading. How do you literally sit down on the charts? What do you do? And how do you, get into taking those entries, execution, and even in those entries and trades, how do we manage them and what do we consider? Of course, all these things are taught much more in depth in their individual lessons where I talk about, for example, there's a whole lesson on risk and trade management where I go into examples and everything. There's a whole lesson on the COT data. So if there's any gaps in these things I spoke about today for you specifically, make sure you revisit those lessons and make sure you get confident on them. And as usual, guys, if you have any questions at all, please just drop me a message.